Hello, good morning, everybody. It is November 27th, Thursday. Welcome to Morgan Stanley's Asia Macro Thursday webcast. My name is Derek Lam. I'm the Asia economist, and I'm your moderator for today. Please note that this event is for Morgan Stanley's institutional clients and financial advisors only. This event is not for members of the press. If you are a member of the press, please kindly disconnect and reach out separately. Please note that this webcast and your question may be recorded. Today, we're going to discuss the 2026 outlook and, in particular, what we have been discussing with investors, and more importantly, what we have been hearing from investors on the feedback of our outlook. But at the outset, I just want to sort of appeal to all the investors who are on this call. The 2026 Excel survey is currently polling right now. All of the members or the speakers who are on today's webcast would really appreciate in the categories that we are competing in across economics, across equity strategy, and also in macro strategy, as well as all the country categories that we are participating in. Of course, your regular hosts, Crystal and Daniel, would also appreciate your support in the poll that is currently polling right now. So I want to sort of open up the conversation by first focusing on the economics part of it. So I want to bring in Chetan into the conversation, and he will share with us what his latest views on the 2026 outlook, what he will look like, what are some of the core themes that will underpin it, and I think also sort of what we have been discussing with investors and what is some of the pushback. Chetan, over to you, please.
Yeah, hello everyone. Thank you, Derek. So I think the key message that we are highlighting is that 2026 will be, from Asia macro perspective, a dynamic where we will transition from tech to non-tech, and the recovery will broaden out. We know that in 2025 trade tensions was the main issue, and some investors do ask as to did it really matter? It surely seems like the markets did not worry about the trade tensions as much. But from a real economy perspective, I think the best representation can be made by this chart on the left-hand side in front of your screen, that trade tensions did have an impact on the economy, but it was on non-tech exports, not the tech exports. As we all know, tech exports, A, are exempted from tariff, but B, also because there is a fundamental trend which is ongoing, i.e. in terms of the whole capex related to AI, that is driving the exports for the region. So this non-tech part has not been doing well, whether you look at Asia ex China or you look at China. And the reason why this is important still is that job creation comes in from the non-tech sector, and Asia being highly trade-oriented, this non-tech exports growth being so weak has had a negative effect on regions' capex, job growth, and consumption. And at the same time, we have seen that that is also something that is important from the overall GDP growth perspective. But the good news is that we think that going forward, now you're going to see an improvement in non-tech exports. And that is because, A, tariff rates have gone down. They're still high, but they've gone down. And more importantly, we have some kind of trade deal being done by almost everybody in the region. The only one which is pending is India, which we are also expecting it to get done soon. And therefore, the uncertainty part, which was a bigger challenge for regions' exports, is behind us. And then when you look into the global demand part of the story, we think that the US is going to see something similar in terms of pickup in non-tech capex. So US capex so far has also been strong, just led by IT capex. But our US economics team expect that this will also shift in favor of non-tech capex in the US. And that US domestic demand pickup will be an additional factor for regions' exports to do well in 2026. We as a team are forecasting, therefore, real export growth in the region to accelerate from 3% in this quarter, fourth quarter this year, to 4.5% in 4.5% in fourth quarter next year. And the countries which are having higher share of non-tech exports to GDP will be the ones will see greater benefit of this turnaround. The connected point which we will see as a benefit is pickup in capex. And at the same time, we have seen Asian central banks cutting interest rates. Usually, there is a lag in terms of interest rate cuts by the central bank and its effect on the economy. And we think we are kind of hitting at that point where the rate cuts that have been taken up should be now incrementally helping this capex decisions from the corporate sector. Of course, the more important driver always tends to be the top line and therefore exports. But it will help that in addition, interest rates are going to be also supportive to that decision making from the corporate sector. And as that capex growth comes through, it will have an effect on wage growth and therefore consumption. As you can see from the chart on the left-hand side, we had seen a meaningful slowdown in retail sales in the region over the last 6 months. And in terms of labor market as well, we had some kind of weakness, but we think that this is all largely connected to non-tech part of the economy. And as that comes back, you should see a turnaround in these two lines as well. So bottom line, we think region's growth will accelerate modestly from 4.3% in this quarter to 4.7% fourth quarter next year. And at the same time, as exports improvement drives improvement in capacity utilization, you should see reduced deflationary pressures. And therefore, nominal GDP growth acceleration will be even stronger than the real GDP growth acceleration that I just highlighted. Going through a little bit on each of the top three economies. So the first one is on China. So for China, our focus has been for those of you who have been regular listeners to this webcast, you would know that our big focus on China is the outlook on deflation. Because as long as deflation persists, it will have a drag on the broader corporate profits and corporate revenues. And from deflation outlook perspective, what we have just seen in the last few months is a significant slowdown in China's investment growth. The FAI numbers, which tends to be somewhat overstated relative to actual GDP component of gross capital formation. Nevertheless, it's still an indicative number for assessing the trajectory or the trend. And that number has decelerated quite significantly over the last 6 months, and particularly in the last 2 months. Monthly number nominal FAI is down 11%. So investors are effectively asking, how do we place this in the context of deflation outlook? And so we think that it is a good thing because one of the three things that we had suggested to be done to address deflation was to stop creating new excess capacity, that is slowing down new investment stuff, cut excess capacities, and then boost consumption to support aggregate demand. So in that context, this measure of cutting new investments is a good thing. However, what we are not seeing in an aggressive manner as a measure being taken is to boost consumption. And so we still think that while deflationary pressures will ease in China in 2026, for a clear exit, we have to wait till 2027. Moving on to India, India is going to be the strongest nominal GDP growth opportunity within the region. We're expecting nominal GDP growth to accelerate from 6.7 to 10.7. And just as a backdrop, this is actually the reason why investors have been concerned about the India markets because normal GDP growth has decelerated from double digits to the 6.7% number. And at the same time, you've seen, the impact of that coming through on corporate revenue growth. And so why are we expecting a turnaround? We're expecting a turnaround for two factors. Number one is we're expecting consumption to go higher from here. And in fact, it is from high frequency indicator, it's already inflecting upwards. And the second part would be a turnaround in exports. I gave the backdrop of how we see the turnaround for regions non-tech exports. India will benefit on account of that. Plus, at the same time, India is also likely to do the trade deal with the US. So a combination of those two factors will help exports to be doing better in 2026. And in terms of the policies which the government has taken over the last few months to get this turnaround going on consumption front is cut in income tax rates for households, a reduction in policy rates by the RBI. There has been a cut in GST, and RBI has also eased the regulatory environment. And then the fifth factor is the fact that it's not something that the government did, but we did see natural decline in food inflation, and that should help real incomes for the households. So that's on India. And then finally on Japan, we think that the main reason why we have been constructive on Japan, which is that normal GDP growth remains strong, that story is, we think, pretty much intact. We are expecting the BOJ to take up a hike in December, but then we expect BOJ to stay on hold for all of 2026. But at the same time, we're expecting the fiscal policy will turn expansionary. There is an other issue with the markets are having right now. Markets are worried that fiscal policy will be way too expansionary. We don't think so. I don't think many investors still appreciate that actually the starting point of fiscal deficit in Japan is just 0.8%. And we're expecting another 1.1 percentage point fiscal expansion next year. What happens is in Japan is that whenever the policymakers announce the fiscal package, they give out a big number. But what you have to look at it is in try to understand is what is the net effect on fiscal deficit. And that is always much lower than the headline package number that you get on Bloomberg. So we think that it will be, as the Prime Minister herself is mentioning, it will be a responsible fiscal expansion that continues to support the Japan reflation story. So with that, let me stop here and hand it over back to you, Derek.
Right. Thanks a lot, Janet. Now, I want to turn the conversation. There are actually already some questions in the queue, but I'm going to have to sort of hold that at this point in time. But I do want to turn the attention now onto Jonathan to talk more broadly about sort of the markets, what your views are, and also sort of what have been some of really the pushback that you have been getting from investors on some of the key calls that you have made. Jonathan, over to you, please.
Yes, thank you, Derek. And clearly, we use the economics view that Chetan just gave as a core input to our process, obviously, along with FX views and valuations and our earnings modeling. So in our view, investors need to adopt what we call a robust approach for an uncertain world. We're not seeing very obvious bang the table market risk opportunities to take here, albeit we have a slight preference for Japan versus EM in 2026. So we are emphasizing stock selection in the form of the 5 focus lists that we run as a team. Given the more constructive view our economists have out to 2027, and the fact that next year, obviously, we'll start to discount 2027, we have raised our base case targets, but we're emphasizing a wider bear to bull spread. And as I'll show you in a minute, the upside to base is very limited given the valuation re-rating that took place in recent months. We are, other than being moderately overweight Japan, somewhat constructive on China, but that's more of a bottom-up story than a top-down story. So overall, it's still an equal weight recommendation for us. As a reminder, Laura Wang, myself and the team put China back on equal weight in January of this year, not going as far as many of our competitors, but a different stance from what we had the previous 3 or so years. We're continuing on into next year with a number of overweights we've had previously. India, where Chetan just covered the cyclical recovery that we expect, where valuations have derated considerably versus other EM. Clearly an underperformer this year, but already stabilizing in performance relative in the last couple of weeks. And then 3 successful overweights from this year, Brazil, UAE, and Singapore, matched off against underweights in Saudi Arabia, Indonesia, Taiwan. Core overweights on the sectoral side are financials, consumer discretionary, e-commerce, and industrials. Underweights on upstream energy, which has been a notable underperformer this year. We think that continues, given our subdued oil price outlook. And then materials in the form of diversified miners. As we've mentioned many times on this call this year, we do like gold miners and we like rare earths plays. And then equal weight ITs, semis, telcos, and real estate. So these are the target prices that we set. And actually with the sell-off last week, we've updated this deck as of November 20th. We do have some modest upside appearing. So on publication, we actually had 1% downside for EM. It's now about 2% upside. And you can see the rest of the numbers on the table. But the key thing really is to look across to the valuations. These forward Ps are very high. We've marked our assumptions lower, but still well above long-run average, anchored really on some improving underlying trends in ROE, not just in Japan, but actually spreading to markets like Korea, Singapore. We've certainly highlighted that. China, at least there's been a stabilization and some individual companies are generating improved ROE through bottom-up self-help. We're also cognizant of the fact that our US team is anticipating valuations sustaining close to current levels. So we don't see a case, at least in the base case, for significant multiple contraction. So really a lot of the differential views that we have are around the earnings profiles. So the 3,600 topics target, 240 yen of EPS for December 27, multiplied by 15 times forward PE. Now, to give you some sense of the differentials on the earnings side, this is the situation right now. So you've got the usual colored lines for the evolution of consensus, EM on the left, Japan on the right, obviously Japan in yen terms, EM in dollar terms. At the moment, we're challenging the 12-month forward high of around $100 that was set actually in the 2017 cycle and the 2021 cycle. We do think that can now break on the base case up towards 108. So we are constructive in that sense. But actually, if you look at the right-hand chart, the base case for Japan is much more clearly, I think, a evolution towards a new high, and the breakout in the 12-month forward, the dark black line here is very strong, and it's broadly based. It's domestic reflation, but it's also sectors like defense, trading houses, and selected exporters, ex-autos, including some of the semi and tech names. So yes, we had a down cycle in Japan EPS, but it only lasted 2 quarters, the first part of the year. And if you look at the revisions breadth right now, so the balance of upgrades versus downgrades across global equities, Europe is lagging. That's the sort of orange line. S&P is leading, something that Mike Wilson highlighted really from May onwards, but slightly rolling over. And Japan is in number 2 position and China's in number 3. It is notable that notwithstanding the macro challenges in China, the company estimates are moderately being revised upwards, really for the first time since 2021. So that's an important macro versus micro distinction. And then, as I mentioned on the valuation side, 22 times forward is the assumption for the S&P. Mike Wilson is talking about policy relief on the rates side of things next year. And we also obviously have one big beautiful bill tax rebates. We continue to have deregulation, perhaps an early productivity enhancement from AI implementation. That's certainly one of 4 scenarios that we have for the US, a more bullish scenario. If that takes place, it would be perfectly consistent with that to have the kind of forward Ps that you see for our coverage laid out in the other colored dots here. We are assuming that China remains at a modest discount in valuations to EM. We've covered off the macro already, and I've discussed ROE at least to some extent, but multipolar world risks have not gone away vis-a-vis US and China. We're certainly in a better place than we were in April of this year, but we doubt that China can get to a valuation premium to other EM. So these are the active risk positions that we have, and in talking to investors about these, I think there are some pushbacks, for example, on the India cyclical recovery that we talked about. There are pushbacks around, for example, the moderate underweight on Taiwan. What I would say on that is note that Taiwan is now the second largest market in our coverage, but with a very pronounced sector skew to semis and IT. And it's also a market that is not without geopolitical risk. So in recommending an 11.5% weight, we are actually recommending a higher weight in Taiwan than, for example, in India. And I think this is a dilemma or a challenge that a number of investors face. In terms of the size of those bets being lower than we've had on average, when we look at this deviation ROE price book, there's been a marked compression in deviation across our coverage this year. In other words, the outliers have got less extreme. The most extreme on the downside, i.e. arguably attractive depending on your cost of equity assumptions, are UAE and Brazil. And I would highlight the relative derating of India, which is typically more of an outlier than you see on the diagram here. I'd also highlight the re-rating of Korea. So in terms of not being overweight Korea, but maintaining a constructive equal weight, Korea is now sitting really quite close on this ROE PB scatter to Japan. So we've had a very meaningful valuation re-rating of Korea, driven both obviously by sector composition, but also the value up reform agenda that our colleague Jun Suk has talked about on this webcast many times this year. Just to sort of wrap it up from me, I'm not going to talk in much detail about our focus lists, but I do just want to highlight that on an unaudited basis, this is what performance looks like. So the Asia ex Japan list has run since 2009 on a daily basis, essentially by the same team, led by me. We have managed to deliver returns this year, and actually with lower volatility than the overall market. And likewise for the EM list on the right, which has been running for almost 20 years now. So do check out the various stock lists that we've gone into 2026, which you'll see on these slides, and obviously this presentation deck is on our portal. So I'll stop there and hand it back to you, Derek. Thanks.
Thanks a lot, Jonathan. Next, I'd like to bring in Gig into the conversation. And for Gig, I think, what we need to sort of think about is sort of generally the outlook for currencies and rates would also have an implication and matter for investors. So what are some of the key calls that you are making for next year in the macro space in 2026? And also, what have been sort of some of the pushback that you have heard from investors? Geg, over to you, please.
Yeah, sure. Thanks, Derek. So yeah, maybe I'll start off in terms of the outlook that we have for the Asia FX and rate side of things. So picking up on some of the things that Chetan and Jonathan mentioned, we do think there are three key themes for Asia currencies for the next year. So the first one is, of course, the most important theme that Chetan mentioned with regards to the export story. So given that we are expecting non-tech exports to pick up next year, we do think it actually creates an environment that could help Asia currencies to do a little bit better after this very lackluster performance that we've seen since the summer, really, for this year. So if we look at this chart on the right hand side, you can see there's a very close correlation between Asia FX and also Asia exports. So if we are sort of expecting sort of tech exports to hold up, but then also non-tech exports to start picking up from next year, then it should sort of argue for Asia currencies to appreciate in terms of direction. Of course, the different economies will benefit to different extents, so that can help in terms of us trying to figure out which currencies could outperform or underperform on a relative basis. But in terms of direction, we do think it points to a stronger AXJ currencies. So that will be the key sort of driver that we think underpins a lot of the Asia currencies. But then we think the second theme that comes in here as well is also the broader risk appetite, because we do think the risk environment should be quite favorable next year, because we have US growth slowing but not going into a recession, and also the Fed continuing to cut rates another 3 times. So this sort of backdrop, plus the Asia exports recovery, is quite good for risk taking. So even in the alternative scenario where our economists have US economy going into a mild recession, we actually have the Fed cutting to a terminal rate of 1%, which is quite aggressive. So we do think that can sort of help the backstop in terms of the impact on risk demand. So generally, we do think that the environment should be quite positive for risk taking. So again, this should help Asia currencies, EM currencies, including Asia, to do well. The only issue for Asia is that we don't have a lot of carry. So actually, if investors do have this strong risk appetite, they would probably go into places where you get a bit more yield. So that would create some issues for Asia currencies, given that most of the Asia currencies are lower yielding as compared to the dollar. So we do think that can sort of help to moderate the extent to which Asia currencies appreciate, which is why we're only forecasting quite modest appreciation for Asia currencies to the tune of around 3% on average. So I think so that's the sort of second theme that we think will be driving Asia currencies as well, in terms of this demand for carry, which might help Asia to underperform relative to, say, LATAM or similar currencies. And then the third theme that we think will be quite important for Asia as well, of course, is what comes from China, because usually, like what happens in dollar CNH would have a spillover effect to the rest of dollar Asia as well. The exception, I guess, is we've seen this year a divergence between CNH and Asia currencies, particularly from late September onwards, when we started to see dollar strength. So as you can see on the chart on the right-hand side here, since late September, we've had Asia currencies weakening, but then actually CNH doing quite well, because it's underpinned by the signal from the fixing every day. So we think for next year, if we take the outlook that Chetan mentioned earlier with regards to the growth and macro backdrop for China, which is sort of more of the same to some extent, because it's still a very gradual economic rebalancing, and we don't really have a strong pickup in terms of inflation or even growth, at least in the first half of next year, then it does suggest that Asia currencies might be less sort of the correlation between Asia currencies and CNH might be a bit lower. So the dollar side of the story might actually matter a bit more for Asia currencies. I mean, of course, a key factor underpinning this as well is that the assumption that the PBOC will continue to guide towards a stable exchange rate, which is also what we've seen today, actually. If we look at the dollar CNY fixing, is the first time that they fixed it higher than market expectations in the past few months. So it does suggest that they are sort of guiding towards a stable exchange rate at this point of time as well. So if we assume that goes forward, then we do think the dollar side of the story might matter more for Asia currencies. And on the dollar side is where we do think there can be more weakness in the first half of next year, partly because of slowing in US labor market data, keeping markets' expectations of Fed policy easing intact. So if we do get a lower terminal rate pricing for the Fed, then we do think yield differentials can push against the dollar to help the dollar to weaken. Plus, also around the start of the year, we do think there could be some room for additional risk premium to be priced into the dollar as well, because there might be more focus on the composition of the Fed with regards to the Fed chair decision, as well as Lisa Cook's case in the Supreme Court as well. So if we sort of go down that road, then we do think dollar has more room to weaken in the first half of the year. So if we sort of try and figure out what's the relative preference within Asia, we would be looking at these few themes to try and make our relative preferences. So if we look at, say, the share of non-tech exports to GDP, the beta to risk appetite, the carry, and where could currencies do a bit better if we have this temporary increase in dollar risk premium, as well as considering some of the domestic stories and valuations, then we do think within Asia, the currencies that could do a bit better are Korean won, Malaysian ringgit, and the Singapore dollar. because they do screen quite well on all these different metrics. Thai baht also screens quite well, but then we do think that there could be some risk premium priced in for the uncertainty around the elections that's currently proposed for the first quarter of next year, and also valuations are less attractive as well from that front. And then where we think the currencies could underperform are in places like Philippines, and also India doesn't screen as well, but then given this sort of backdrop of a growth recovery that Chetan mentioned earlier, and also the slightly more positive take that Jonathan has on the equities as well. So we do think they can help to provide some support for the currency. So we do think Philippines might be the one that underperforms a bit more. So yeah, that's how we're thinking on the Asia FX side. On the rate side, we do think there's also going to be sort of three key drivers for the rates markets. But in general, it's going to be a change in environment because we've seen Asia rates rallying for the past few sort of past 1-2 years actually. And so we do think actually next year we might see a change in trend coming because central banks are nearing the end of the easing cycles, and we have this growth recovery plus this inflationary pressures abating, and also so we do think this environment should be quite conducive for yields to head higher. So we do think the three key themes driving the rates market side firstly will be the end of the monetary easing cycles, which is the most important one, because we think some of the Asian central banks are already done with the easing cycles, and even for the rest where we have a bit more easing to come is quite modest, at most 3 rate cuts from places like Indonesia and the Philippines. So if we compare that with market pricing, it's actually our expectations are still a little bit more dovish in some of these places like Thailand, as well as China, for example. So we do think in some of these places there can be opportunities to try and play for lower yields still. But then generally for the rest, we're actually a bit more or less in line with market pricing for next year, and actually a bit more hawkish than market pricing for 2027. So that's why we do think as we sort of progress through the year, we get past this phase of lower US yields plus a bit more sort of growth softness from the US in the first half, we could actually see yields pushing higher as we get towards the second half of the year and people start to think about the 2027 or the growth recovery sort of outlook. So that will be a key theme there. And I think the other theme as well is also on the inflation side of the story, because if we do have sort of inflation going up a little bit to more normal, normalizing from the current very low levels, then that could also be one factor that pushes Asia yields up as well. So in Asia, in places like India, Philippines is where headline inflation, Chetan and team are forecasting a larger increase in terms of the year-on-year rates. Whereas in places like China, Taiwan, and even Thailand is where you see smaller increase in inflation rates. And then the last sort of theme that we think might be playing into investors' minds on the rate side of things is on the fiscal policy side. So, I mean, in terms of our expectations, we don't really see big changes in terms of fiscal policy. So it's just going to be modest changes on a relative basis, like who could be a bit more expansionary or who could have a bit more consolidation front. So on that front, like we do think India and Thailand screen quite well in terms of the consolidation front, which would be bullish for rates. Whereas in places like China, you have a bit more of a more expansionary fiscal policy there, but just modestly. So if we put all of that together again, like if we consider all these three themes, then we do think where rates could actually outperform a bit more in places like China and Thailand, given that growth is still quite modest, inflation is still very low, plus also the monetary expectations that we have are a bit more dovish as compared to market pricing. And even if they don't actually deliver the cuts that we're expecting, the hikes would seem quite far away given the sort of domestic growth and inflation backdrop. So we do think these are the places where yields can actually still stay low. And then in places where we think yields can have a bit more room to rise, in say Korea and Malaysia, because central banks are done with the easing cycle, especially as we've seen this morning from the BOK decision. Plus also we have inflation or growth picking up as well. And so we do think there's those places you could see a bit more of room to rise in yields. India yields we also think has room to rise given there's pickup in inflation and also RBI closing close to the end of the easing cycle there. So that's why we do think India can also have some room to rise on the yield side as well. So maybe with that, let me pause there and hand it back to you, Derek.
Great. Thank you very much, Greg. Thanks for bearing with us. I know we've unpacked a lot of things over the last 30 minutes or so. But if there's anything that you would like to follow up on any particular theme with any one of our speakers, please feel free to reach out to them, and I'm sure they'll be more than happy to accommodate the request. Moving on to the Q&A section for this part, I just want to have one question real quick for each of the speakers. Chetan, I want to start with you first. Earlier on, you showed the chart on CapEx, right? And I think if you look at the CapEx in China, it's not just the real estate which is actually weakening. And we've known that the weakness in real estate has been there for some time, but now it's very broad. It's looking like it's really broad-based, right? There's manufacturing that's coming into the picture, which is weak. Infrastructure is also weak as well. Do we actually expect this weakness in CapEx to be sustained? What does it actually really mean for the deflation outlook? Isn't it great that if, let's say, China is indeed cutting excess capacity?
Yeah, so I think, Derek, that's a fair point. And as I was mentioning earlier in my initial remarks, that it's a good thing. But what we need is that at the same time, you need some source of demand in the economy. Because in the interim phase, when the investment growth is decelerating, if there is no alternative support from demand, then the deflation problem could actually get exacerbated. So in our base case, we're expecting that the infrastructure spending will be pulled back again. To just recall, the reason why infrastructure spending seems to have slowed sharply is because the local governments had the funding issue. In October, the government released a 500 billion RMB package for local governments, and that spending should begin to come through. It should most likely be coming in through from the November data that we'll get in early December. And at the same time, we are expecting non-tech exports growth to improve. So that will be the other factor that will help manage the deflation environment to be somewhat better in 2026. But if we don't see that revival in infrastructure spending, if we don't see the government taking some additional measures to support consumption, even if they are modest, and if we don't see this exports recovery, then we think that it'll actually be a factor that will cause further deflationary pressures rather than receding some of those deflationary pressures. Back to you, Ray.
Yeah, thanks a lot, Chetan. Jonathan, I want to bring you back into the conversation. There's a lot of attention sort of on Japan equities at the moment, right? There's sort of like this depreciation that we've seen in the Japanese yen. We've also seen, the fiscal concerns, which is sort of probably linked to the fiscal concerns that Chetan was talking about. At the same time, there's also the recent sort of tensions within China and Japan. So how do all these factors really come in to sort of affect how you think about Japanese equities, probably in just a very near term? Jonathan?
Yeah, thanks, Derek. So these all fit into what we call this uncertain world. And in our note, we went through 6 dimensions of macro uncertainty. One key one, of course, being the whole multipolar world theme that we've written about so many times in the last sort of 6 or 7 years. And I think on multipolar world, there's been a tendency, maybe this year in particular, to think that it all orbits around the United States of America. But China-Japan tensions are clearly a sign that there are other issues that exist between major geographies that can affect investor portfolios. So for sure, we do take that into account in our thinking. Just on the narrower issue of the yen, the profile that we now have is for moderate yen strength from here. That should be broadly supportive for equities, particularly because export earning Japan is modeling for around, say, that $140, $145 yen. I think that the news flow since the fiscal announcement, we've certainly seen as rate expectations firm up for a December hike from BOJ, and they're back now to anticipating a cut from the Fed. Our house view is that it's a very close call, but the futures are now starting to discount that again. That's why the yen is strengthening. So about a week ago, when we were talking about this report to our clients, you were getting a tinge of that sort of should we be worried about capital flight from Japan? We did get verbal intervention from the BOJ, but actually the yen has begun to strengthen in line with our base case forecast. So that greater stability in the yen and the long end of the Japanese yield curve is probably why equities are now back to making nice gains. Thanks.
Thanks a lot, Jonathan. I think there's also another currency gag that is in the focus of investors, and that's the Korean won. Obviously, we had the BOK meeting this morning. We had some policy announcements yesterday as well. So near term, how are you thinking about the Korean won? How's positioning like? Are there any sort of like catalysts that you might be watching out that can sort of swing the currency one way or the other? Okay.
Yeah, sure. Thanks, Derek. So I think on the near term side, we are actually still leaning more towards the bullish side. So actually, when we put out the outlook last Friday, we added this short Taiwan against long Korean won trade, mainly to play for this sort of divergence in terms of valuations, given that, and also potential divergences in the hedging path from here among the local investors. So one thing is, if we think about where Korean won is trading right now, it's like about 1465 now at this moment. So if we get further weakness of the Korean won and we get to see around 1485, we would be getting close to levels that might actually trigger hedging activity from the National Pension Fund in Korea. So that we think would be quite important in terms of changing the flow dynamics and also investors' perceptions on the flow dynamics. So you could say the downside is a bit more limited from that front. And if I think about the outlook for flows going forward, that we do actually think things can improve. Because Korean won has been so weak, partly driven by the outflows from the domestic retail investors to buy foreign equities. We think that has been a key sort of driver of the weakness. So on that front, like if we do get the dividend tax reform passing by the end of the year, then we do think that could be a catalyst to sort of reduce the outflows from domestic retail investors. It would still be outflows, but we do think it can be less. So we think that would be one sort of catalyst to look for in terms of like the passing of the dividend tax reform, which should come next month when we get the budget through the parliament as well. And then the other thing is also on the FX measures that they've been discussing. So earlier in the week, we had the Finance Ministry, Welfare Ministry, as well as BOK and also MPS coming together to form a consultative body to discuss FX measures. So we do think that would be another catalyst to look for. The timeline is a bit unclear, but historically, like we've seen in December, there can be announcements on the MPS hedging behavior or also on the FX measures. So that could be a sort of a time to look for. So yeah, these would be some of the key catalysts that we're looking for in order for the more bullish view that we have on Korean won to play out. I'll say investors have been quite skeptical. There's quite a bit of pushback on this bullish call, mainly because people think that the MPS flows are still a structural drag on the currency, and you do have this large foreign investments by the domestic investors. So people are struggling to see what's the catalyst that would turn that around. So yeah, we do think it was a bit early for them to do any announcement on measures yesterday in the press briefing. So we do think it will take a bit more time, and there could be the likelihood of measures coming is still out there. Like the door is still open there. So that's why we are a bit more constructive on that front.
Yeah, thanks a lot, Greg. I just wanted to sort of thank all the speakers for sharing their thoughts today. It's been a wonderful 45 minutes or so, and I would also like to thank the audience for staying with us for the last 45 minutes. Obviously, if there's still any sort of questions that you might have for any of our speakers, please do feel free to reach out. And then just one last appeal from our side, currently the Excel Asia Research Team survey is polling right now. everybody on this call, and of course, anybody from the Morgan Stanley research team would clearly appreciate your support in the survey that is currently polling. And with that, thank you very much for joining us today, and have a good rest of the day and have a good rest of the week ahead. Thank you. Bye-bye.